It's time for Yahoo Finance's Market Minute. Stocks are lower as investors scrutinize earnings and weigh the impact of President Trump's trade agenda. Walmart shares are falling and on track for its worst day since November 2023 after the retailer warned of slowing profit growth in fiscal year 2026. Walmart CFO saying of the conservative outlook, quote, "We have to acknowledge that we are in an uncertain time." And Chinese tech giant Alibaba set for its best day since November 2022 as investors consider its potential as an AI play. The company reporting a 13% rise in cloud revenue, CFO saying he expects growth to accelerate. And shares of the gaming platform Unity Software reversing course, now up double digits after initially falling this morning. The company beating analyst expectations in its latest quarter. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the session. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Housing Hurdles will discuss why tariffs could have a major impact on home builders and the price that you'll ultimately pay for your home. And Inflation Nation. Walmart is out with earnings. We discuss how inflation has hit your wallet when it comes to your grocery bill and discretionary purchases. Plus, career hacks. We discuss how to pivot your career with purpose. I'll be joined by a career expert from LinkedIn. All that and much more coming up during today's show. But first, we take a look at some of the market action. We're 90 minutes into the trading day. Stocks are lower today. The S&P 500 pulling back from a new record high. Joining me now, we've got Keith Buchanan, who is GLOBALT Investments Senior Portfolio Manager. Now, you say the market is starting to pay less attention to rhetoric that we've been hearing from Washington. What does that mean and translate to through for investors?
Hi, Brad, and thanks again for having me. We just noticed how the reaction of the markets has started to diminish some when it comes to the big statements, and whether it's through social media or through some of the faces you see on the news shows and political back and forth, which don't think the reaction is as vitriolic as we saw, over the past couple of weeks. And the market's starting to grasp what is happening. The proverbial sausage is being made, and getting its arms around an administration that had a totally different take on how to handle these situations as far as the public-facing statements. And there's a bit of adjustment that had to happen, but we don't see the reactions of the previous couple of weeks continuing as the back and forth about trade continues to progress with us in China, the North American back and forth that we're seeing as well. So we're moving past that. The market feels like it's starting to get more of a grasp on the cadence of this trade rhetoric, and we think that coming forward in the next couple of weeks, that will continue to diminish.
Do you think that cadence, even as the markets are trying to best anticipate what that cadence looks like from here, that there's still the potential for a volatile reaction here from what we've seen in some of the tariff announcements or even the broader economic impacts of immigration policy?
Absolutely. There's always potential for a negative reaction. We feel like the rhetoric is starting to, the reaction from the rhetoric is starting to diminish, but when the policy starts to take shape, that will still, of course, move markets one way or another. But we're seeing the market start to decide between the rhetoric evolving and what's turning into policy. And the former will cause intraday moves. The latter, of course, will dictate where we go the next couple of years and be a little more impactful to market direction. But just the day-to-day rhetoric is being looked at as being perhaps not how the policy will end up, and that's critical, we think, over the next couple of weeks as the market starts to get its footing behind earnings.
And so, Keith, while we have you here and we're talking about earnings, we got, of course, the best barometer for retail, perhaps, at least in the U.S., with Walmart reporting here today, and them having a clear line of sight into how consumers are still purchasing everything from groceries to some of the discretionary spending. What are you seeing as a pull-through, perhaps one of the denominators about the consumer through an earnings report like that?
That's a great question. Walmart is a holding we have, and we look at this name as a stalwart of not only where the consumer stands, but also inflation and as a hedge in an interesting way. As they picked up more customers, as they define the more affluent customers, those making an income of over $100,000, that traffic has continued to improve, as we saw started to happen when inflation really reared its head a couple of years ago. Walmart is also in the process of monetizing traffic through its app. Also really pushing forward on the delivery experience, whether delivery at home or to the car, where that also gets captured within an e-commerce business, which is still growing at a clip that is impressive. What happened to Walmart, in our opinion, is the valuation was well north of the market because of that execution they have displayed over the past couple of years. The stock has been rewarded for it. And the sell side and buy side assumptions had moved north of where reality of the company had grown. So the anticipation and frankly optimism about the company had probably moved a little further than the story had developed. And we're still comfortable with the execution. The management team highlighted inflation being perhaps a limiting factor this quarter in the grocery space, and that's not necessarily anything that we didn't feel like was warranted. So, Walmart, in our opinion, is still a company that executes at a very high level. Again, gives us a read through to the consumer, but also picks up flow of traffic of customers, frankly, that haven't shopped at Walmart in perhaps a decade or so. So we're really excited about the story. The valuation again is rich, and today offers an opportunity perhaps to get more involved.
It sounds like it's still one of the top picks for you and the team here. Another one of them is Delta. Take us into your thinking there.
Sure. Delta's riding a wave of travel experience that we saw pick up in a very material way right after the pandemic really started to wane, and really hasn't slowed down. And we've seen flocks of people coming through TSA turnstiles, and we have data on this on a daily basis. We're running well north of the best travel of the year, which was 2019. At the same time, we've seen fewer worldwide carriers. Now it used to be 7 or 8, 15 years ago. Now it's 4 big global carriers that now can have a little more discipline as far as what routes are or have how much capacity, and have a lot more sustainability to fares that we've seen have inflated over the course of the last 4 or 5 years. Delta specifically still has the business travel component. It's actually shaped itself into being more of a luxury carrier. The business component is still coming back, but we've seen pay down of debt now, the investment grade quality debt, and the cash flow they're generating right now really bodes well for the continued traffic we see coming through air travel here in the U.S. and internationally, and also the capacity to be able to keep prices sustainable and actually moving higher to capture more of that marketplace. So we're really excited about the opportunities that Delta shares offer our clients as well.
Keith, thanks so much for taking the time here with us today. Appreciate it.
Absolutely. Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills. Maddie, first up, we got to talk a little bit about Airbus this morning. Trading lower after guidance disappointed investors. The plane manufacturer missing on estimates for adjusted EBIT and free cash flow for 2025. Its plane delivery target falling just shy of expectations, 820 planes versus the 823 planes that were expected here. Shares right now down by about 2.5%.
Yeah, a couple of interesting things here. Of course, the production challenge is something that was very key for investors heading into the call, and that did become clear. Them flagging that short-term production pressure and confirming a delay to its A350 freighter, as it did predict a 7% increase in deliveries to around 820 jets this year. But they are going to continue to clean up some of the trouble that they are seeing in their space and defense projects. That was not enough to give investor optimism, though, given that delay in the A350 aircraft. Their Interesting commentary, though, from the CEO, talking specifically about competition from a Chinese aircraft manufacturer. He said on the record that he could see the duopoly between Airbus and Boeing becoming a triopoly between Airbus, Boeing, and this Chinese company Comac that has really sort of developed their own version of the Boeing 737 that has gotten a lot of attention, specifically amid all of the headwinds that Boeing is facing with safety of that aircraft in particular. So I think that the CEO of Airbus kind of fueling that question mark was a really interesting decision there, perhaps one that he thinks will position them better as sort of news that would negatively impact their competitor, Boeing, as well. But interesting to see him adding to that idea that Comac could be a real competitor here.
Yeah, it's a major acknowledgement, especially given that these two companies, in Airbus and Boeing, have really been able to account for 90%, a little over 90% of the large plane manufacturing orders that the market has seen here. So we'll continue to track Airbus shares today. Let's get a little more tasty with it, though. Shake Shack is rising after fourth quarter earnings result. It was a mixed quarter for the company. Baird analyst David Tarantino saying that the company and the commentary implies a better than feared start to the year. Shares right now, they're up by about 10%, perhaps on some relief here, at least in line with what the analyst was saying.
A lot to like under the hood of this report, but in particular, there was concern that the company had raised with investors that the wildfires were going to be a significant headwind for them, and then their Jan comp sales, just for the month of January, comp sales were up 3.7% year over year, so that's what that Baird analyst is referring to there, this idea that the print was better than feared. But there's, again, a lot to like outside of that. Raymond James talking about how the company has impressive labor leverage, given that their fourth quarter store margins rose by 22.7%, specifically talking about how they've been able to leverage their labor costs really effectively. Again, William Blair talking about a resilient trend for the month of January. Also, I think it's interesting that they talk about how long-term this is one of the strongest and most proven growth runways among emerging restaurant brands. So that is significant for a company like Shake Shack that has a lot of competition in the space from the likes of Sweetgreen, Kava, all of these other recent IPOs in the space, but clearly seeing a positive lift to Shake Shack here, which again is also, I might add, lastly here, significant given some of the pressure that we've seen in the other retailers amid consumer weakness, the likes of Walmart being the latest among them. Seeing Shake Shack be able to kind of buck that trend of consumers buckling under the weight of inflation is really impressive.
All right, 13% sales growth system-wide there. Not too shabby at all for Shake Shack in the most recent quarter here. Maddie, thanks so much. My stomach's growling already.
Yep. Thanks, friend. Appreciate it.
The majority of 401k and state-sponsored IRA plans offer target date funds, or index funds that shift from risky to more conservative investments as you get closer to your retirement date. But you don't have to rely on someone else's plan to make that happen. Yahoo Finance's Kerry Hannon set up her own target date retirement fund, and you can too. Kerry, walk us through some of the steps that you took.
Hey, Brad, thanks a bunch. I'm not exactly a do-it-yourselfer, but when it comes to my retirement investments, I like to have a little more hands-on than just set and forget, right? So I decided I was going to create a custom target date fund for myself. And so what I did is I picked the date that I thought would be the year, ostensibly you would retire. So maybe it's 2035, 2045, whatever it is. And then I looked at the various mutual fund companies and other financial services. T. Rowe Price does this, Vanguard, Fidelity, on down the line. And I looked at what their target date fund in the year that I selected as when would be my retirement date. I looked what their funds had and what the holdings. Number two was, so I picked the date and I did my research of who had a date fund in that year. The second thing is I checked the holdings. What does that target date fund hold? Which index funds? And generally they are index funds. Do they have an international fund, a total stock market, a bond fund, international bond fund? Number three is look for low expenses. I looked through the different fund companies. Fees are across the board. These are typically fairly low fee investments. So you want to go there. The fourth thing I did was, I picked who I was going to go with. And in my case, it was Vanguard. I already had an account there, so it was pretty easy. I opened up my IRA there, my individual retirement account there, and I added the funds. I looked at exactly what their fund had in that target date. I added those precise funds into my own account, but I tweaked it a little bit because whereas they had a certain percentage in equities and a certain percentage in bonds, I wanted a little more equity exposure. I was a little bit more of a risk taker than they had aligned for me. So I tweaked it just a bit, but I used that as my guidepost, right? So, I'm not going to go flying down into the gutter with my bowling ball here. I use that as my guardrails. And the last thing that I do is every so often, and certainly once a year, I go back and I rebalance it. I tweak it to get it exactly to make sure the asset allocation is right for my risk tolerance and my time before I think I'm going to need those funds. And so it's very important to sort of look at it, rebalance it, because now you're in control. There's not a fund manager who's going to be a target fund manager who's going to be doing that for you. And the truth is, Brad, I actually ended up with a lower cost fee because the target date fund as a whole was more expensive than the individual index funds that I put into my account. But I'm not paying for someone to manage it, right? I'm taking that responsibility. But I got to tell you, it's loads of fun, and it keeps me paying attention to my investments. Maybe not everyone wants to do that, but it makes me feel in control.
Kerry, thanks so much for breaking this down for us. Appreciate it.
Thanks, Brad.
Coming up, the impact tariffs could have on home builders and even the price that you pay for your house. We break it down with Jim Tobin, who is the National Association of Home Builders CEO. You see him there. Stay tuned. Frigid temperatures and tariff woes across the U.S. are taking a toll on the housing market, according to a slew of data this week. Housing starts fell sharply during January, while permits inched up slightly, though a decline on the year-over-year basis. Home builder confidence for February also dropped to a 5-month low as builders remain cautious about the future. Joining me now, we've got Jim Tobin, who is the National Association of Home Builders CEO. Jim, good to have you back on the program. Just want to get your read through the state of the housing market as you see it.
Well, I think right now it's stuck is the way I see it. Between I know I'm reading this week with a drop in 5 points on the HMI. Not surprising given what you said, the tariff woes, immigration, of course, the pace of the new administration and uncertainty around the market. Plus, we're also looking at a stubbornly high mortgage rates hovering near or close to 7%. The existing market continues to be locked up, and I think builders are starting to wonder how soon we're going to see this recovery we've been hoping about.
And so what would be the key to that recovery? Is it actually just lower mortgage rates from here, or is it more supply actually entering into the equation?
The only way we're going to build ourselves out, or the only way we're going to get out of the housing affordability crisis we have across the country, is to build more houses and apartments. And so that's a combination of things that are going to allow us to do that. Number one, we need the regulatory environment to get better for us. We're hoping that President Trump will do that from his perch at the top of the government pyramid. But we're facing headwinds with potential tariffs. We already have tariffs on Chinese goods coming in. There's the hovering threat of tariffs on Mexico and Canada, our two best trading partners. In fact, the president last night announced potentially another 25% tariff on Canadian lumber. We get 30% of our lumber from Canada, and that will certainly crimp our ability to build more houses, but build those houses affordably.
So that seems like, at least from what we're talking about here, and hoping that we were going to see help coming from President Trump on the housing front, it seems like a double whammy, though, is actually happening here, both on the supply side and building out some of these homes because of the potential for these tariffs to be enacted. And the question remains of how long they would be on the table. But then also on the employment side, as you're seeing even more of a crackdown on immigration and some of the workers that would potentially help build out some of these homes.
Yeah, it's definitely mixed signals here in the first month of the administration. The president signed an executive order on day one that was trying to direct his government to help build more housing and build more housing affordably and drive prices down. But yet the immigration enforcement actions we're seeing are having a chilling effect on the construction workforce. The threat of tariffs, again, potentially layering on more costs, whether it's on appliances or whether it's on lumber and building materials. That's really running counter to that executive order in our mind. Again, we have not seen the regulatory rollback we have, but it is early days, and we expect those to come over the next months. But we do have these mixed signals, and you see that in our HMI reading, where the builders are, when they're looking forward, it's not as rosy a picture as they thought just a few months ago. So still a long way to go, but there are some headwinds in front of us.
With that in mind for the builders, I mean, one of the popular things that they've implored is doing the mortgage rate buy downs. Do you see that being something that is not going away anytime soon?
It depends. The larger builders are going to have a better capacity to do that. In our reading this month, we saw that incentives are actually falling out there. I think that's just more the lack of traffic than it really is whether those incentives are working. But smaller builders that build the bulk of the housing in this country, they may not be able to offer those deeper discounts on rate buy downs. It's still a valuable tool, especially as you're trying to get mortgage rates down from the high sixes into the magical fives. But it's going to take a little bit of time and a little bit of work for buyers to come off the sideline and feel that the biggest investment they're going to make in their lives, that they've got a good runway to be able to pay that mortgage and afford that home.
I want to try and squeeze in two more quick questions while we've got you, Jim. Number one, how is affordability impacting the regions that you're seeing as hotspots right now?
Well, if we have to build more houses anywhere, of course, the hot spots are the southeast and the southwest of the country, kind of the Sun Belt. We continue to see people want to move down there, whether it's for the lower regulatory environment. Lower home prices are really driving a lot of that in-migration from across the country. But again, we're seeing these pressures starting to put on those markets like Dallas or Houston or the Miami markets and Orlando markets. So it's everything is starting to impact. Again, tariffs and immigration policy are really starting to squeeze every market in this country.
Well, also a consideration for two of those markets that you mentioned in Houston and then additionally in areas like Miami, Florida, is, of course, climate. How is insurability in some of these climate areas that have been more prone to potential billion-dollar disasters as measured by NOAA impacting the purchase propensity that we are seeing right now because of the insurability?
People still want to live on the coast, or they want to live next to rivers. They still want to live where they want to live. And insurance is going to be the next big affordability crisis we're facing. We're already facing it. In some instances for multifamily properties, I've heard 200% or 300% increases in their annual premiums. Again, that's going to get passed along to renters. Same thing with home buyers. If they can't afford the insurance product on a home, they're going to look other places. So I do think that the insurance crisis in this country is going to start moving people to those lower risk markets. Perhaps in the Midwest, where you don't have the threats of these natural disasters. But insurance is something we're watching very, very carefully. We've got to get our hand on it. Again, it's going to be the biggest driver of affordability in the next few years.
Jim, always a pleasure to grab some time with you and get your perspective. Thanks so much.
Yeah.
Coming up next, we're diving into the state of the consumer with Walmart earnings. Those shares are under pressure. But fear not, investors. I spoke earlier with TD Cowen senior analyst Oliver Chen, and he says it's still a long-term play in his book.
It's not a cheap stock, 38 times PE. You can't forget that. We have a buy rating. We like it for the long term, and we like this whole flywheel between technology meets value meets grocery leadership.
Weak guidance for the full year is weighing on shares of Walmart this morning. With more on what the retailer's earnings tell us about the state of the U.S. consumer, I'm joined by Yahoo Finance's Brooke DiPalma. Brooke, you actually had the chance to speak to Walmart CFO John David Rainey this morning. What did he tell you?
Yeah, John David Rainey kicked off the phone call with Yahoo Finance this morning, really trying to alleviate any fears among investors that there's something between the lines here, some sort of concern about the economy or business. He told Yahoo Finance that he feels really good about the state of the business right now. And he described the state of the U.S. consumer as steady and consistent. He said specifically that we can see that their wallets are still stretched, so they're far from what we might call back to normal. Consumers are buying more private brand items. They're spending more on food versus general merchandise as they have historically in recent years. Now, he echoed what we've also seen in recent inflationary reports like the Consumer Price Index, that eggs continue to drive inflation. He said that is driving up the overall portfolio. And in a distant second, other items that are still inflationary include bacon, sugar, canned soda, as well as that ground beef. Now, consumers are also returning to general merchandise. We saw that this quarter for the second time in a row, and that's driven by what he said was a better assortment of products as well as a growth of its online marketplace. Now, some items that they're seeing deflationary within the general merchandise category includes headphones, TVs, sporting goods, as well as pet food. But keep in mind, should potential tariffs go into effect, that could offset. He told Yahoo Finance that Walmart is not immune to the potential impact of these tariffs, but they typically will work with suppliers on this. He said we'll shift supply where we need to. We can lean into our private brands. There's a lot of tools that we have to try to keep those prices lower for consumers. Now, one source that I did speak with this morning said specifically that Walmart has this bit of a leg up here, that they're very good about working with their vendors and their suppliers to keep those prices low. So should those tariffs go into effect, well, they might have a leg up against competition here to once again keep prices low. That could then drive in even more consumers than they've seen in recent years. We know higher income consumers are going them for value and convenience.
Yeah, absolutely. They got great golf shorts too. Brooke, thanks so much. Appreciate it. Shares of toy maker Hasbro rising after topping analyst expectations in its latest quarterly report. It did, however, in its 2025 revenue forecast come in below expectations as Hasbro included the impact of tariffs on imports from China and potential levies on Mexico and Canada. For more on this, I'm sending it on over to our very own Brian Sozzi, who has Hasbro CEO Chris Cox on deck. Soz?
All right, thanks so much, Brad. Yeah, Chris, always great to get some time with you here. Stock ripping, one of the hottest tickers on the Yahoo Finance platform. Some of the folks I talked to this morning, Chris, saying they've given you high remarks for cutting costs. Like, how much in costs have you cut out of this business the past 2 years, and how much more is left?
Gosh, I think we're over $600 million of costs taken out of the business. Probably about 2/3 of that is via our supply chain, and then the balance is from just general overhead and admin savings.
Can you get to, what else do you have to do to get to that 1 billion mark? I think you put that out today as part of your longer term plan.
Yeah, we still have some general admin and overhead that we can save. So that's what we pay for vendors. That's kind of like the overall kind of overhead associated with the company. Supply chain will be a big contributor for us as well. We're doing a lot for design to value to take costs out of our products, but still maintain really good quality. And then there's this whole thing that's called gross to net, which is basically the difference between our gross revenue and our net revenue. And that has to do with how much discounting allowances we put into place and other kind of trade allowances that we put into place, generally to account for overbuilding a product. So the better we get at forecasting and the better we get with supply chain management, the less we'll have to put in there. And, you know, when you look at supply chain, gross to net, and kind of like our general kind of like overall spending, that really kind of forms the lion's share of how we get to $1 billion of cost savings by 2027, which was the revised target we just talked about today.
Chris, I'm inspired by everything in your background. I think those are all toys that I would purchase maybe at some point soon, but I do realize I'm not the norm. Why are toy sales in the US still under pressure? What's going on here?
Well, Brian, I actually would say you're increasingly becoming the norm.
It's because I'm getting old, right?
Yeah. The fastest growing segment in both video games as well as toys are people over the age of 13. You know, the biggest segment now in video games is actually consumers 35 plus. So high-end collectibles, things from your childhood, that's a big, powerful motivator for the toy industry, has been for the last couple of years, and I think will be for several more. Unfortunately, Hasbro has its better than its fair share of volume from that. 60% of our sales are from 13 plus. Now, there is a little bit of pressure in some other areas of the toy category. A lot of that just has to do with the toy volumes normalizing after the pandemic. You know, the toy category has been down kind of like low single digits per year for the last 3 years. We see that starting to flatten out and basically being flat for the next 2 to 3 years. You know, we think Hasbro will benefit. We've got a great innovation portfolio coming out. We have strength in that quote unquote kidult segment. And we have a very diversified business. It's not just toys, it's also licensing, which is a business that's up 60% for us over the last 2 years, as well as games with some huge franchises like Monopoly and Magic the Gathering.
Chris, how much of a headache are tariffs to a business like Hasbro?
Well, it's certainly one that we'd like to minimize. The toy industry in general thrives on sub $10 and sub $20 price points. A company like Hasbro has been working very hard to take costs out of our mix and push more value into the channel. And like when you think about the typical American family, probably 95% of American families have a Hasbro product inside of their toy chest or inside of their game chest at the home. Our hope is that we're able to get through this phase of tariff negotiations, find a good conclusion that allows us to keep prices low and bring smiles to kids' faces at price points that are as low as possible.
Is the reality, though, Chris, that this coming holiday season will simply be more expensive?
I think a lot depends on how the whole tariff scenario plays out. When we look at like the current kind of like guidance that we've given, which factors in the 10% on Chinese tariffs, pricing will be a variable that we play with, but I think it will be very targeted. So, in general, our focus is to bring more value and more products at sub $10 and sub $20.
Can you manufacture toys profitably in the United States?
We do. So a lot of our Magic the Gathering business, which is by far our biggest brand, it's over $1 billion and drives a heck of a lot of our bottom line health. It's made in North Carolina and Texas. We manufacture board games in Massachusetts. So certainly we can do it. I think the challenge with manufacturing a lot of toys like action figures and kind of like higher turnover toys is it tends to be, those toys tend to be very manual to create. And they also tend to have a fair amount of turnover because like about 50-60% of SKUs in the toy industry change each year. It's a fast fashion category. So I think bringing back manufacturing jobs to the US would require us to do very heavy automation, and it would be a pretty heavy lift and take multiple years.
Fair point. Lastly, Chris, too, it's not lost to me that you have another partnership with rival Mattel. I remember you announced something similar with some other brands more than a year ago. Is the reality that given the cost environment, tariffs, cost of labor, you name it, that your two companies are going to have to work together?
Well, I think the reality for Hasbro is we already work with Mattel, we already work with Lego, we work with Spin Master, we work with all of the major toy manufacturers. And I think that's an advantage we have. We see partnerships as an opportunity to extend our brands, to bring more value to new consumers, and to make some money in the process. As I said, our licensing business is up 60%, and that's a very high margin business for us. So I see that as a power trend moving forward and something that's just net goodness, whether it's Play-Doh plus Barbie, like we just announced today, Transformers and Hot Wheels, D&D plus Lego, or supersized board games like we do with Spin Master.
No chance in hell I'll be able to make one of those Play-Doh Barbies. I'm just going to say it there. I wanted to get that out publicly. Chris, looking forward to seeing you around the Toy Fair. Chris Cox, Hasbro CEO. Good to see you.
Thanks so much.
All right, Brad, back over to you. Out of everything, I can still smell Play-Doh, Brad. It's like one of those smells you just don't forget.
Yeah, you don't forget it at all. You'd like to pretty quickly, but perhaps it brings back some of those childhood memories, Saz, for sure.
Or nightmares.
Oh my gosh. Well, depends upon what you were doing with the Play-Doh, I suppose. We can take that offline. Saz, thanks so much for that interview. Appreciate it. A programming note, on this week's episode of Stocks in Translation, Jared Blickery and Sidney Freed sit down with Peter Borish, who is the Computer Trading Corporation CEO, to discuss tariffs and a strong dollar.
If you're going to put tariffs on, how do you fight that? Well, guess what? You depreciate your own home currency. That then offsets partially the impact of tariffs because the dollar gets stronger. So there's this tug of war, and when things get out there, and I know this is a shock to a lot of people, but people in this administration, they tend to have ego. So if it's not working, they're going to go more. And they're going to go until something breaks, and that'll probably be a second derivative speed of the dollar.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern on Yahoo Finance or wherever you get your podcasts. Coming up, the state of the labor market. We have tips to help you pivot careers with purpose. That's next on Well. Let's get a check here on the markets as we are 2 hours into today's trading activity. We're taking a look at the Dow Jones Industrial Average. It's actually down right now by about 1.4%. Let's pull up the chart on this one just so you can see some of the slippage that we've been tracking intraday. Of course, that is a longer term view there for the Dow. And this is what's happening here now, as Luther Vandross would say. We are down by about 1.4% as mentioned. The NASDAQ composite, that too is down by about 0.9% on the day. And the S&P 500, which just yesterday did see some new record highs as well, that is down by about 0.9%. So retracing just a little bit from those levels, but still in the general ballpark, or at least in the parking lot of the ballpark. As of right now, we're also taking a look at some of the moves within the sector activity on the day. Let me jog on over to that and put this on an intraday here. Somebody's been active within the Wi-Fi Interactive here today. Financials, you're seeing that lower by about 2.1% during today's session. It's been continuing to slip here during today's activity on the front half of today's trading session. But take a look at XLV. That's finding some gains, finding some love here for healthcare. That's up by about 0.3%. And lastly, here's just a brief look at the NASDAQ 100 as we ride out with a quick look at that heat map here. Also, everyone, switching gears. This Black History Month, we celebrate the power brokers in business, the executives, the entrepreneurs, and proven change makers who have advanced the economy and society. Sean Tresvant took the helm as Taco Bell CEO on January 1st, 2024, making history as the first Black American to lead the company. He joined Taco Bell in 2022 as their Global Chief Brand Officer and later expanded his role to Global Chief Brand and Strategy Officer, leading to his promotion to CEO. He carries a wealth of experience from his 15-year career at Nike, including serving as the Chief Marketing Officer for the iconic Jordan brand, and is currently on the board of Marriott. Under his leadership, Taco Bell has been dubbed one of the twin growth engines by Yum Brand CEO David Gibbs. Tresvant provided 3 leadership lessons to Yahoo Finance, and here they are. Number 1, you don't have to have a black belt in everything. Leadership isn't about being the best at everything. It's about recognizing that you can't do it all. And number 2 here, it's hard to make a crunch wrap, but keep at it. My first attempt at the elusive crunch wrap fold during his restaurant training was far from perfect, but with time, practice, and the courage to ask, it got better. The same is true for any skill in business or in life. Growth doesn't happen overnight, and success isn't instant. And third, from Tresvant, service with a sonrisa, smile. Leadership isn't all about standing on the sidelines. It's about showing up, setting the tone, and leading by example. When you bring your best self, your team feels it and follows suit. Sometimes it's the smallest gestures, even a smile, that makes the biggest impact. The number of Americans filing new applications for unemployment benefits rising slightly last week to 219,000 from a revised figure of 214,000. That increase is still consistent with a healthy labor market, but Wall Street is watching for any signs of cooling as the Fed continues to battle sticky inflation. Here with more on the jobs market is Andrew McCaskill, career expert at LinkedIn. Andrew, great to have you back with us on the program. Let me just get your read of the labor market right now from what you're seeing.
Listen, I think the numbers aren't going down that much, right? So we're still in a strong labor market, but a strong labor market can be a double-edged sword. I mean, with steady hiring, employers may not feel the need to add, new perks or to raise wages. But keep in mind, these numbers do not include the more than 200,000 federal workers who had their roles eliminated. And the question on many people's minds is whether or not the private sector will be able to absorb this influx of federal workers who are rejoining the labor market. It's already competitive. And now there's another 200,000+ folks who may be in the market.
And so with that in mind, for those who are trying to, and we're going to come back to the government side of this in a hot second here, because that's very important. But as you're thinking about the role types that are still continuing to be in demand right now, even in the conundrum and the mechanics that are, the machinations that are taking place within the jobs market right now, where are those roles still in high demand?
Listen, I think we see a lot of opportunity for folks in hospitality, and we see a lot of hiring that's happening in a lot of hiring that's happening in healthcare, a lot of hiring that's happening in education. We'll come back to those sectors a little bit later when we talk about government employees. But I think that where people have to do is they have to think about, if you're not getting those roles right now, or if you've been in the market for a while, pivoting is essential, right? You've got to look and say, now the time is to pivot. Opportunities still exist. Sectors like retail and healthcare continue to show really strong job openings, and you got to make those moves really strategic. If you're breaking into a new industry, and it requires professionals to really be clear and connect their existing skills to those new roles. And the bottom line is the job market may be tighter, but there's so many professionals who pivot with a purpose can still land new opportunities.
And so you have 3 tips for pivoting with purpose. What are they?
Listen, number one, you've got to own your transferable skills. Skills like leadership and problem solving, creativity and strategy, those things are always a big ticket to get into other industries, right? Like right now, it's February, it's Black History Month. We talk to Black professionals in particular, and the tip number 2 about seeking out community and mentorship, 65% of Black professionals said that networking and mentorship has driven their career growth, right? And that's really interesting because about 64% of them say that they're looking to change jobs this year. You got to do things like upskill and staying sharp. If you're interviewing and you're not getting those roles and you get all the way up to the interview part and you don't get hired, interviewing might be one of those skills that you need to bone up on. Also, identify gaps and level up. If you're seeing job opportunities out there and you're looking at those job descriptions and you don't meet every single criteria in this economy, you've got to say, how do I fill in that gap? How do I take a course or upskill so that I can fill that gap in? And technology is your friend on this. And I would say that even if I didn't work at LinkedIn.
Certainly. Andrew, while we have you here, let's talk about a little bit more what you were mentioning at the top here. We are seeing many reports of layoffs and buyouts across various government agencies as the Elon Musk-led Doge looks to cut costs. Can you provide some tips for those workers who might be out of the job and looking at new roles?
Listen, I think smart pivots for these folks means chasing growth. Government workers have incredible skills around policy and communication and management and regulatory expertise, but they need to package them the right way. Number one, you got to flip your resume like a pro. Frame your expertise in policy or crisis management or compliance in terms that the private sector actually understands. So translate that government speak into private sector impact. Instead of things like stakeholder engagement, think about it as a corporate partnerships work, right? Or constituent services. You may need to talk about consumer engagement. The language here really matters. Take a look at job descriptions that are in the private sector and say, okay, this is what correlates to that. So flip that resume like a pro and your LinkedIn profile. The other thing I would say is be really strategic and then follow the growth. According to LinkedIn data, the top industries that government workers have historically pivoted to, there are 4 of them: professional services, education, manufacturing, and hospitals and healthcare. Now that you know where people have historically gone, now you go where the growth is. Healthcare and education are hiring above pre-pandemic levels. Now, on the flip of that, you've got to say professional services and manufacturing, they're still catching up. But if you're thinking about who typically hires people from government, right, and then which of those sectors are actually hiring right now, you're ahead of the game. Mm-hmm. And then finally, you got to activate your network, man. I know I talk about networking a lot, but government careers are built on relationships anyway. Right. And so if you've been engaging with private sector companies in partnerships and things like that, reach out to those folks that you worked with previously. Right now, it's February, it's Black History Month, and we're doing a series called The Power to Pivot, where we talk to Black leaders about major pivots in their careers and their career journeys. Mm-hmm. And one of the folks that we talked to was a lifelong public servant, worked on the Hill, and used a relationship and a conversation that he had with someone that he'd worked with and pivoted his role into a corporate job in their policy division, right? Yeah. And so that's just the way it works. Those relationships are going to help you out.
Andrew, we got to leave things there. Thanks so much for taking the time today. Appreciate it. Coming up, everyone, if you're one of the 86% of Americans who had financial goals for 2025, listen up. We're breaking down the top ways to improve your saving habits. That's on the other side of this break. A whopping 86% of Americans surveyed by Bank of America had a financial resolution going into 2025. 71% said that they expected inflation and cost of living to impact their spending. Joining us now with some tips for all of this and much more, we've got Mary Hines-Drosch, who is the Bank of America Head of Product for Consumer, Business, and Wealth Management, Banking and Lending. Mary, great to have you here. As an expert, we got to know, what are your top 3 budgeting tips?
Well, thanks, Brad, for having me. As you can see, 86% of the consumers we surveyed really are looking to have better financial health, but it's really hard to stick to it. You start January, you have your resolutions. I'm going to save more. I'm going to pay down my credit card debt so I can take big trips. But what happens is those resolutions don't really result in anything. So we recommend set specific goals and really stick to them and be intentional about how you spend. One of the tips that I personally use is a do not spend list. I have a lot of everyday luxuries. For example, I get a latte on my way to work. Its price has increased 30% over the last couple of years. So in the month of January, I would not let myself purchase that Monday through Thursday, and I would treat myself on Friday. Those are small things that really add up to big savings. Another thing that's just the reality of the world today, it's so easy to spend money. It used to be you could freeze your credit cards as a way to constrain your spending, but now your credit card is embedded into digital wallets on your phone, within apps. You click a button and you're spending money. So one of the things I've done with rideshare apps, which is another one of my temptations, instead of taking the subway, I take a rideshare, is I deleted the app. So I no longer can click that button and keep that spending under control.
And so while we have you, what are 3 things Americans are prioritizing in their budgets right now from what you're seeing, and 3 things that they can start to deprioritize perhaps this year?
Yeah, well, as you mentioned, 71% feel the impacts of inflation really impacting their ability to keep good financial health. And so groceries continue to be a priority because that's really what's gotten more expensive. Things like eggs have over doubled in price over the last couple of years. Also, wellness. People are really focused on health and wanting to do right in order to feel good and live long, healthy lives. And so that things like yoga studios and exercise bikes continue to be important. And then finally, travel. 40% of people said that that was a big priority for them, and that's up from 32% last year. So we continue to see life experiences being the priority for our consumers.
Mary, thanks so much for taking the time here with us today. Some really interesting findings and insights, and hopefully I'll do a little bit better on my own budgeting this year too. Thanks.
At your do not spend list.
Exactly. Everyone, that is it for Wealth. I'm Brad Smith. Thanks so much for watching. You can stay tuned for Market Domination coming up at 3 p.m. Eastern Time. You don't want to miss it.